Hello, welcome back to Weekly Market Recap. Night alone this week. Let's get to it. So this past week, actually a really positive, great week in the market. The NASDAQ was up 7.52%. The S&P 500 was up 6.48%. Still year to date, the NASDAQ is down 25.82%, and the S&P 500 is still down 17.94%. But let's get into why the market was moving. So shockingly, this past week, we didn't really get much good news. In fact, Fed President Jerome Powell came out and said, we are going to fight inflation. We've switched basically our dual mandate, which is maximum employment and stable prices, and we are going to narrow in on we need stable prices. And saying that they're going to continue raising rates, trying to get demand down as dramatically as necessary so that way inflation in the long run does come down. But let's jump into what we actually saw in the market. So we started off the week with a bump up in equities, which was really nice to see. And we did have a little bit of a pullback on Tuesday the morning, but really just within this trading range up until late Thursday. And then Friday, again, another just really great day in the market. Now, part of this could just be we've been beaten down week after week. We're down 9% over the last 2 weeks. So being up 7% or 6% in 1 week, we are still down in all of June. So we're still trying to fight to come back. If we go out to a month, we see exactly what I was talking about, how we started June higher and we did leg down pretty significantly, and we have started to come back, but we're still not even at where we were at the beginning of June. And then if we look at the beginning of June, we still see that we were significantly down from where we were even March. So overall, the still trend has unfortunately been down, but we are starting to see a break in that trend. Now, one of the big unknowns is this just a bear market rally? And it's very common in bear markets at certain times to see a couple week rally, even maybe a month rally. We actually saw that back in March where we had sold off significantly. We went on a 10% run back to the upside, only to continue falling down when we got worse news. The biggest things that are still affecting the market is inflation. And in fact, consumers in general are talking about inflation almost as much as they are talking about COVID. So it's clearly on everyone's mind. And something that shocked me when I heard about this week is inflation expectations right now are anchored, but they have the potential in the future to get worse. Now, remember that the Federal Reserve has the ability to slow the pace of their interest rate rises of the prime rate, the federal funds rate, if they have stable inflation expectations. Back in the 70s, the biggest issue and why Paul Volcker needed to come in so aggressive was because inflation expectations were unanchored and kept rising. And then you have that pattern that we've talked about a lot, where if people expect higher inflation, they buy more products right now, which then actually leads prices to go up, higher inflation. So unanchored inflation expectations leads to more inflation. And so right now we've been relatively stable and in fact starting to trend back down. If you see the 5-year break evens, we've actually come down about 20 basis points. So we're now back under 3%, still higher than the 2% long-term average that the Fed is expecting. And again, that's the market expectation right now is we're about at 2.8% inflation in 5 years from now. That's still relatively high, but that's more anchored. Now, here is the interesting fact that I hadn't really thought about before. What is the geopolitical landscape going to have an effect on inflation expectations? One of the things that politicians do when they're up for re-election is they take that headline, what are the worst things going on right now? And one of the worst things is inflation. So wouldn't it be surprising to me if right before the election or as we get closer to November, we start seeing more political ads about, look how high inflation is. all over the place. And then what happens is if people think inflation is getting worse, inflation expectations might actually start to tick up. Now, what happens if inflation expectations start to tick up? Well, we might have the Fed temporarily see inflation expectations higher and have to react rapidly. In fact, we had two reasons why the Fed jumped from 50 basis point moves to a 75 basis point move. One was we had awful just CPI data in May. And then two was we actually started to see inflation expectations start to tick up. Both of those together, Fed had to increase the interest rate hikes. So if we get closer to November and we see inflation expectations start to become higher or lose that anchoring, we could see the Fed make more dramatic moves, which at that time, if we're not seeing inflation come down, could just be an even more dramatic, depressing move for the market. Now, this probably isn't the base case of what's going to happen. And hopefully in the next 3 months, we really start to see prices come down. Every day, it feels like there is some data saying that people are not spending as much. People are really being conscious of where they're spending. So hopefully we could see that. But at the same time, we still got one of the worst inflation readings in May, and we're coming up soon to get our next inflation reading. And if it is, again, another miss, we might be back in this situation where inflation's bad, the Fed is raising rates rapidly, and if inflation expectations due to political ads or target, look how bad inflation is, we could see that start to rise, making the Fed have to act even more. Now, what does that mean for portfolios? So right now, we're going to be rebalancing very quickly, very soon, and it's going to heavily trend away from growth. So growth has been a great place to be over the last 10 years. It's actually outperformed over the last 20 years. But if we're looking at this current environment with interest rates still continuing to rise, probably through the rest of the year, it doesn't make sense to maybe be as overweight growth. Now, in the long run, if we were in a normal market environment, inflation came down, growth is a great place to be. But with high inflation, interest rates rising, it's a tactical shift to realign the portfolio. So we'll be doing that soon and trying to get through our rebalancing cycle as quickly as possible. If you have any questions about that, as always, reach out to us. We're here to support you. Your money's here to support you. And we'll see you again next week.